happens. This internal line comes in around 32.57. The high of the move was 51.60, so that would be a new high. But my point is, we're almost at new highs here, right? And when we were here last time, the yen was here. Now the S&Ps are back here, and the yen is in a recovery mode for major support at 108.50. I lean towards selling further strength. Keep in mind that tomorrow is NFP, so kind of silly to go, become aggressive in front of the number. You could have a toe in the water, but I wouldn't mind to see a decent number in the jobs number tomorrow and have a little dollar strength and a sympathy pop in the yen to short, because I think there's a good chance we take out 108.5. So we'll see. This is like a quadruple top. I guess I've heard people believe you could have, there's such a thing as a triple top, but not a triple bottom. Okay. Stream is back. Guys, I just want to make you aware that our TI guy for broadcasting, Bellew, is all over it. And YouTube, okay, YouTube is back on. The NFP is next week, Mark? Okay, thanks, man. All right, so then, you don't have...
Happy New Year.
Happy New Year, Steve.
Happy New Year to all. And, may the new year bring you everything you wish for.
I don't know. Sometimes it's good not for all your wishes to come true, because they're not all good. They're not all good for you.
Traditionally, the 2nd of January is the strongest day having to do with seasonality in the year. Something like 3 out of 4 days.
75%, huh?
Yeah, is up days. So, there are a lot of people that trade seasonality. So I'm not surprised that, we have an update today.
Okay.
I was more or less expecting that.
Well, how about the magnitude of it, though?
I wouldn't pay so much attention to it, really.
Okay. New highs.
Yeah, might be. Yeah, sure.
Yeah. Well, you'll have a lot of non-confirmations you didn't have at the last high.
Yeah.
I think it's the 1/1,000,000th and one RSI divergence in the last 20 years. So write down that statistic, everyone. So we'll, as far as the euro goes, you still have to like it, So, if you're a little anal about breakouts and like the 112, it's done nothing wrong, and it won't do anything wrong, even short term, until we're back under like 111.40-ish. In fact, I would attempt a short here. I still think that we're going to 114, which was a long talked about target back based upon the falling wedge. All right, there's 114 all the way on the left-hand side. Everyone see that? Give me why. So, wedges have the potential to retrace 100%. So I have a special guest for our viewers at investing.com, someone with an equity bias. I mean, that's his bailiwick. So we're going to be speaking with Dana Lyons at the top of the hour, and Dana's work. He contributes to See It Market, Yahoo Finance, and he's out of Chicago. And I haven't talked to Dana for years. Looking forward to doing that. Perhaps we get some kind of views on what sectors he's looking at going forward into 2020. So stick around for that. Happy New Year, Blake. The stage is yours.
Hey, good morning, Coach.
How you doing, Blake?
Good. I'm Happy New Year.
Happy New Year.
Yeah, did you go outside and bang pots and pans?
I was asleep. I did go out for a couple hours, but I was I think I was asleep by 10. I couldn't make it. Anyway, no.
No.
Did you guys? I saw a picture. You had a little
Actually,
party.
surprisingly, I made it up till midnight. You know,
Oh wow.
it was 2020. I mean, it's the beginning of a new decade, so I had to make it. Usually, I don't make it, so
Yeah, that made it a more important one.
it really did. And
Yeah.
yeah, we had you know,
After as many decades as I've seen, they're kind of like just another decade. Although you run out of them eventually, I found out.
right. No, this is the time where you got to start celebrating them. You know,
Yeah.
and
Celebrate. Yeah.
the big question has been, you know, are we at the last year of the decade, or is this the new year of the decade? And my opinion
Yeah.
is the new year, right? It's the
Yeah.
new year.
Steve says it's a year from now.
Typically
See-
speaking, it's a year from now, but we as humans tend to care more about the third digit of the year. So we say, the 80s, the 90s, the 2000s. So,
My dog cares about every digit.
Well, well, if it is the, you know, like if you think about like Y2K,
Yeah, I
Y2K
remember
was,
that. Yeah.
yeah, it was two. It
That was a big
it
New
was
Year's, and
yeah, it
everyone
was 20.
celebrated.
It was
Yeah.
20 years ago.
Yeah.
It was 20 years ago.
Amazing.
20 years ago in a day. I mean, so we're starting this third decade of this century, right?
Yeah.
So this would be the third decade. So I mean,
When I was a kid, I used to think about, oh my God, the year 2000. How old will I be?
well,
And
now you found out.
now you know.
Now you know.
Now you
Well,
know.
now that it's 20 years later, I can't remember.
Well, so I guess talking about the markets, we are seeing some volatility. We had a cut come in from China.
That's what did it.
Yeah, it was China's banks ready reserves. They cut it by 50 basis
PBOC.
and
right.
it's
Yeah.
freeing up, according to Reuters, it's freeing up 115 billion, and that has helped obviously risk appetite. You got stocks back at the highs. It's like, oh geez, here we go again. We're about ready to test the highs again in the S&P, and then we have like the yen's a little weaker, but it's interesting. And I pointed this out in the webinar, and I'm going to talk about the Aussie yen really fast. The Aussie yen is actually down on the day, and you would think that the Aussie yen would be one of those currencies that'd be a lot stronger. I do want to note that we are up against a major 618 retracement. We might be developing like a bull flag pattern here, but the fact that it's not higher with risk appetite is very alarming to me. And like overnight, I was long the Euro New Zealand. I told everybody I want to say it was on Friday, but it wasn't on Friday. It was Tuesday.
And that RSI Aussie yen, Blake, it just can't close over 70. You've had like 1, 2, 3, 4 tests of 70 on the RSI. You can't call it a divergence, but it sure is showing what you're talking about technically. That
it's
higher highs and no confirmations.
Right. Well, it is divergent as we hit new highs in price here.
We're not making new highs.
We're not making new highs in relative strength. So, and yes, it is definitely finding resistance at the 70 on the daily RSI. But the point I'm trying to make here is the Aussie yen should be a lot higher with stocks higher.
Should be your upper trend line, red trend line up there.
Well, that comes in a lot higher. I mean, this is where we should be at least.
Yeah.
We should be way up here, but we're not. And so, while we're holding below this 76.60, I don't know. I'd be pretty nervous about being long the Aussie yen, considering stocks are higher, stocks are near all-time highs, and the Aussie yen is not moving. I did, like I said, on Tuesday, because I keep thinking it was Friday, because I think today's Monday. It feels like Monday, but it's not Monday. It's Thursday. New Year's obviously throwing everything into a little bit of a tizzy. I talked about being long the Euro New Zealand on Friday. I bought it last night. I picked it up last night at 61 down here. And then I sold it this morning up in the 20s, 20, 21, I think is where I sold it. But this is one of those that last night when stocks were higher because of the news out of China, I'm sitting there looking at the Kiwi, and I know the Kiwi is way overbought. This is something that I think we talked about on Tuesday. If you look at the relative strength on the New Zealand dollar on the daily, well, not now, but we drew this relative strength. I'm pretty sure we did it here on the webinar. If not, we were talking about it in the chat room. It's sometimes I can't. I'm trying to think where we discussed all of this, but because in the chat room we had, at least in the chat room we had this discussion. Relative strength was pushing above the most recent highs, and I'm like, that's way overbought. So my idea was I'm going to buy the Euro New Zealand, or I'm going to short the, or I'm going to buy the Euro New Zealand because of the overbought nature of the Kiwi. And when the over the weekend news came out, over the weekend, over the New Year news came out, geez, like I said, it feels like a Monday, but it's not. I went long the Euro New Zealand. I spun out of it already. I got in and out for like 60 pips, but the Euro is doing what I thought it was going to do. Is we're going to pull back here, and we are pulling back. The 38% retracement in the euro dollar, it comes in at 111.75. I think that's where we're going to be going, but we might even get a little further than that. I would not be surprised if the euro makes it down towards 111.50 before actually bouncing. But I do want to be a buyer of the euro on dips. As I told you guys on Tuesday, I am looking to buy dips. And like I said Tuesday during the webinar, I am not chasing it up there where it was at when it was trading at 111 or 112.30, 112.40 on the webinar 2 days ago. Was it 2 days ago? Yeah, 2 days ago. I said I'm not chasing it up here. I want to have a pullback. And we are getting that pullback. The question is, how far are we going to pull back? And like I said, if we can get towards 111.75, I'm interested. And if we get down towards 111.50, I'm really interested. So the question is, again, how deep is this pullback going to be that we get in the euro? Is what we're seeing right now? Is this it? It's possible, but we'll see. So anyway, I'm like I said, I'm looking for a continued pullback in the euro dollar. We're seeing the oversold dollar bounce back. I mean, this is a broad-based bounce back. We're past the end of end of year flows, if you will. So all those, all that dollar selling that came in earlier this week, it's been done. The dollar didn't make a new low. My assumption is here, looking at the dollar index, my assumption is we're going to be doing something that looks something like this. This would be my assumption. I'm not, obviously I'm not certain of this because I'm not a fortune teller. I'm not a, but I think the dollar is going to be consolidating its recent losses, because if you think about what the dollar has done, the dollar has broken out of this channel, right? Here's this long-term channel. We've broken down out of the channel. I think we're going to be consolidating below the breakdown point. So therefore, I want to be looking to sell dollars on rallies, and that goes along with hey, I want to buy the euro I want to buy the euro if it dips much further. And you take this dollar index. My assumption here is once again is that we're going to do this and then probably break down at some point. Whether this is the ultimate place to be on the short side, or maybe over here. I don't know. But that's my working assumption on what the dollar is doing right now. It's just it was getting oversold. It's got to work off some oversold conditions, and then and then we could look to take advantage of more dollar weakness. That would be more euro strength. And again, you know, if I can get a pullback in the euro dollar and another 20, 30, 40 pips, that's going to be what I'm looking for. One of the other things that I want to point out is the cable. The cable rallied to the 618 retracement, so you can see how we sold off, bounced back, hit the 618 on, that was on Thursday, Friday. I did go long the euro pound, which was the right trade at that point, because the pound was just, you can see that squeeze was happening late in the day on late on the day on Tuesday. And I was like, man, this is just all flow related. That's all flow related. Just kept squeezing. And the euro pound was breaking down, and I picked it up at 61. I picked it up around 61, and then I sold it at 72. And you know, I really didn't have anything more to do with the euro pound other than it was just oversold, and I was just picking up from an oversold standpoint. But if you look at the cable now, you know, I'm actually pretty bullish the cable while we're above 129. I think that while we're above 129, this is very constructive. And overall, I believe the pound dollar is going much higher, especially this year as we you know, go through the Brexit process. It's just being more strategic on where we buy the pound versus, you know, just outright, you know, buying the cable. I think that buying the, you know, you could probably buy the pound here, open your eyes 6 months from now, it's going to be higher. You know, but is there going to be a better place to be long the cable, you know, between now and 6 months from now? I think so. So you know, I'm not just out there blindly buying the cable and getting long and saying, you know, that, you know, see you later, see you in a few months. I just think that the pound is going to, overall, it's going to be trending higher, and I want to be a buyer on dips. Just you know, trying to figure out where strategically I want to be on the long side. That's what I'm going to be trying to figure out here probably over the next week or two. And as you pointed out, Dale, well, you had said that the non-farm payroll is this week. It is not. It's actually going to be next Friday. So
Right.
yeah, it's just
I'm a big news trader. When I know it's happening.
No, the good news about that is that we will get, I think we're going to get all the ISM readings ahead of the jobs report.
Yeah.
So this way, non-farm payroll probably won't be as it won't be as you know, won't be as how should I say, impactful, because we're going to have you know, the jobs report will hit us you know, after a lot of data has come out. So that's, you know, that's going to be
it hasn't been impactful for such a long time anyway. Maybe it's because people are paying more attention to ADP, Blake.
Yeah, maybe ADP, looking at you know, some of the other, you know, whether it's the PMIs and the jobs components there, the ISM, the jobs component, because everybody's looking for you know, a kind of a clue whether or not we're heading out of this full employment picture. You know, everybody, we I think last year, 2019, you've heard me say it, so many non-farm payrolls, we're at full employment. You know, so being at full employment, it's like, yeah, we gain, you know, 150, 200,000 jobs, 90,000 jobs. We're not losing jobs, but we're basically flatlining, but continuing to gain. And I think what you know, traders are looking for is any clue that picture might be changing, where we start seeing, you know, either in, inflation in the form of you know, wage inflation start to pick up, or if we start to see, you know, cracks in the surface from this full employment picture that we've been in, with unemployment at such low levels, if we start to see that tick up, and we start to see some job losses. But I think traders are now looking in different areas. They're not looking at just the jobs report. They're looking at, like I said, the ISM and different PMIs that are coming through to give us a better picture. So we'll see. But like I said, non-farm is next Friday, not this Friday. So I guess the question is, what do we do today? With stocks where they're at because of this, move that happened in China, it'll be, really interesting to see what equities do from here. The one thing that we can, see clearly is we might, depending on what happens today, we might make a lower high. But the equity markets are right back at their high. So I think that the question that everybody's asking is, are they going to maintain these gains? There's a lot of traders that actually anticipated that China would make some sort of monetary move like they did. So, we might get a little bit of a sell-off, coming into today, but I don't know. Gains are holding up pretty well right now as it is, and it's also interesting. You would have you didn't see it for the market actually on Tuesday. We closed right here at 32.20, but the futures market rallied substantially. We rallied from 32.20 to 32, I want to say 32.32, 32.35, somewhere around here. We did this after the equity markets closed, and for the next 2 or 3 hours before the futures market closed. So it's like the market knew that was coming on Tuesday after everybody was done, after the stock market closed. It's like the futures just ripped for like a couple hours after the fact. And it's like I said, I think somebody knew that was going to be happening over the New Year's holiday. So anyway.
I'm sure that the regulators are going to be closely monitoring at that note.
Yeah, I mean, but it was interesting. Like I said, futures were ripping. Like they just started screaming, because I didn't notice it, because
there are always people that know. Always.
Yeah, there's somebody always knows, right?
Yeah.
Right, exactly. So but like I said, what equities do from here, we'll see. And anything else that I really wanted to mention, the euro dollar is, I really want to buy a dip here, but it's not dipping to where I want it to dip to, and I'm not sure it's going to. I'm kind of hoping it does, but I might just end up sitting on my hands the rest of the day. Remember, this is a full month too, guys. Today is Thursday. Tomorrow is Friday the 3rd, but we still have 4 full weeks of trading, and most traders are not coming back until Monday. So there's going to be probably very little liquidity today and tomorrow. Not saying that we won't get any moves, but I don't think that you're going to see anything too substantial the next couple of days, because most traders, like I said, are not in front of their computers today. They're still on vacation, celebrating their holidays, with their families, traveling, and they'll all be returning to their desks on Monday. So I would expect better liquidity come Monday and Tuesday. So Steve, how was your New Year's celebration?
Good. We had a nice time.
Oh, good. Yeah, didn't you say you were up till 4 a.m?
Remember, he doesn't drink, so.
Yeah, he told me he had half a glass of wine, which is
true. Half a glass of red wine. Yes, that's true.
Oh my gosh!
I admit to it.
Yeah, did you throw up afterwards?
Of course not.
Oh man, that's great. Hey Stelios, I'm sure you had more than half a glass of wine.
Oh yes, I did. Happy New Year to everybody.
Happy New Year to you. And Dale, I don't even know. Did you celebrate it with alcohol or not?
Yeah, I had a beer.
Oh, well, oh.
and amber at this what they call those places that make their own, a brewery, like a brew pub.
A
I had beer.
microbrew.
Yeah.
Nice. Very
That
cool.
was good. Gave me heartburn.
That's the problem with the beer. Is
Yeah.
it
Does it give you heartburn, too? You're
Huh?
too young to get heartburn.
No, I do. Well, if I drink beer and eat pizza at the same time,
Oh yeah.
like late at night, yeah, I'll get heartburn. And so
Yeah. You need to keep Tums around with.
Yeah, I do actually. So anyway, well, I'm glad everybody had a happy new year. I'm really, like I said, I'm really looking forward to 2020. This is going to be this is going to be a pretty big year in terms of volatility. In my opinion, I think FX volatility is going to be coming back. So I'm glad that you guys are all here with us now. Keep in mind that we will have a New Year's offer for Forex Analytics, and we'll be hopefully launching that here in the coming days. So we hope to see you all part of the Forex Analytics community, because you only catch us here on the webinar for an hour or two a day, but this is where myself and the rest of the team are at throughout the course of the day. This is the Forex Analytics private chat room. You can see we not only talk about, well, we're all wishing each other Happy New Year here, but we talk really about markets all day long, and that's where I spend my day, is in the chat room. So if you are looking to be part of the Forex Analytics team, to be involved in our community, make sure you take advantage of the New Year's offer when it's released. So guys, I'm going to turn it over to you, but Happy New Year, everybody. Thanks for being here with us. Thanks for all the support, and I'll see you here tomorrow.
Happy New Year, Blake. Thank you.
Happy New Year.
We're also going to have a blog post coming out probably today about our outlook for the year ahead. So watch out for that. That's going to be free. Okay. Thanks, Blake.
Thank you, Blake. So how are you guys doing? Everything okay?
Good, Stelio. You?
All right. Very good. Very good. So what have we got for this new year? Well, we said, when was the last webinar? Was it Tuesday?
Yeah. Yes, the day before yesterday.
Oh, by the way, we had some US.
I know. I that's why I pulled it here.
Yeah, in line.
Yeah.
Whatever. Yeah.
No. Exactly as expected. I mean, 222 versus 225, so a non-event, and even the revision was a non-event from 222 to 224. Yeah. So I don't expect the needle to move from this.
Yes. So we said on Tuesday, what we think is going to happen next year. I said, I think we all agreed that initially we might see a pullback of the recent move. The dollar had been losing ground for most of December. I still think, we saw it a little bit, like cable is under pressure, the euros are under pressure, but it's not moving that much yet. Like Blake said, it's not really a proper dip to be buying. I think that within the next week or so, we might see a little bit more of this kind of move. But my view remains that the dollar in 2020 is not going to do very well. As a result, I think dollar pairs are going to be affected. The metals should do well, and
metals are already doing well. I think they will continue to do so.
Yeah, silver and gold today again, they're up again. They've had a pretty good run, and if you guys remember from gold's breakout from, what was it, 1365, 1370, something like that. It was a really strong run. Then it pulled back and didn't quite get back to those levels. I thought it had a chance to get back to the breakout level, and I was saying that this would be a dream for a buying opportunity. It didn't, and now it's back above 1500. It's and looking pretty strong to start the year. So
while platinum is breaking out, by the way, I'm going to show it later. Yeah, so platinum seems to be finally waking up. It had a rough decade, getting hammered on a weekly basis. Then it went into a period of hibernation and accumulation. And as it seems, we're now entering a new era for platinum. If this gets confirmed within the next few days, it seems that it's finally going to start shining again. And as I was mentioning,
well, Tuesday, now that it's your platinum, it is a new era.
As I mentioned.
Can anyone else have? Will you share your platinum with the rest of the world, man? Come
as
on.
I mentioned on Tuesday, I think that the platinum ratio against several metals are also looking like good trades. I mean, the gold platinum ratio. I even like more the palladium versus platinum ratio, which was like extremely overdone. It's already something like almost 2% down today, by the way. So I think those are nice trades and completely uncorrelated to anything else. I mean, if you want to play the ratio of platinum overperforming after a huge period of underperformance against some other metals, and as I said, I like palladium. Palladium is extremely overbought. It went from being a very cheap metal to being the most expensive metal. And platinum followed the exact opposite path. It went from being the most overvalued, not overvalued actually, the most expensive metal to being less expensive than gold, than palladium, which when this move started, it was worth multiple times what palladium was worth, and now palladium is worth like at some point it was worth more than twice. So it still is actually. So I do think that those are good opportunities. For example, to look at it on the chart before we go to the rest. Here is the palladium platinum ratio, right? It has clearly turned lower, and I do think this is still an excellent opportunity. Here's the gold palladium ratio, broke down through this triangle, retested it, and I think it's it's going to end up retracing the full ascending wedge, as theory says. I mean, when you have an ascending wedge and you break down from it, theoretically speaking, you should retrace back to the bottom of the wedge. So we can easily retrace back to 140. But as I said, between the two of them, I like the ratio against palladium, much more. I'm bullish both platinum and gold for the year ahead, and silver, obviously. So I agree, Stelio. I think those metals will keep overperforming. Of course, nothing moves in a straight line necessarily. So we might see pullbacks, but I do think that pullbacks should produce nice opportunities to buy them again. So as simple as that.
I
You think
agree.
it's possible, guys, that we could see a pullback in gold to the most recent breakout was around 1480?
It can happen.
Yeah.
It can happen, but I wouldn't bet on it. I wouldn't bet on it. It can happen. Yes, and it
Oh,
could
look,
be
you even have a line like thinking it could do that. All right.
Yeah, we talked about it in the webinar. I said that if we get lucky and we pull back there, that's going to be a great buying opportunity. And I said that if we see some flows coming back to the dollar, that might move silver and gold back to the breakout points. But as we see, even when we saw some dollar strength coming through, silver and gold didn't actually care about it. Yeah. I mean, they kept their gains, and this is a very, very bullish sign. And
are
let me tell
those
you something.
fibs, Steve? Are those fibs that you have on the chart, like where we're at? It looks like we're in between 61.8 and 78.6, based upon the high of the move
from the previous high.
Okay, thanks.
Yeah, from this high, that we
Sorry
saw
to interrupt.
on 4th of September. Yeah,
Okay.
from the 4th of September high, yes. And don't forget, my target, my medium-term target remains the 61.8 of the all-time high to the low that we had here in
1050.
November of 2015, which is at 15. Let me see. 86.7. So I think we're going there. I think we're going there. And I think we're actually eventually going a lot higher than there. And if we want to, speak a little bit about, time frame of a decade, don't forget that gold peaked in 2011, right? We saw that high at 1920, whatever it was, in 2011. And it has since suffered quite a weak decade, But this whole period there looks like accumulation to me, and especially considering, and this is what I love the most, the fact that being long gold also aligns beautifully with the fundamental viewpoint. I mean, what we know for sure is that central banks have gone back to full monetary easing and debt monetization mode. In my opinion, and you're going to read all that in that article, but I believe that the one thing and the one thing only that central banks are going to succeed during this decade is actually um, uh, to bring back inflation, which has been absent. In my opinion, it hasn't been absent. I've said that before. I mean, the way they're measuring inflation makes inflation appear a lot lower than it is. Inflation is a lot higher than reported by governments, but still it is a lot lower than you would expect given the 10 plus years of monetary lunacy that we've had. But there are plenty of reasons for inflation not coming back through all kind of retail prices. One thing is for sure, though, if the dollar turns lower, which I think that during this decade, when we're looking back in 10 years from now, we're going to see that it's going to be in general a decade that the dollar will have underperformed by a lot of other currencies. That's my personal viewpoint, because the fiscal position of the US is a lot worse than the fiscal position of the vast majority of the developed countries, and at some point this is going to start mattering again. It might not be in 6 months from now, it might not be in a year from now, but it's not going to go unnoticed for another decade. There is no question about it. And we know one thing for sure: the Fed has clearly stated that it has absolutely no intention of fighting inflation. Up until a few years ago, if there was a common understanding between central bankers, and if there was a single common understanding between central bankers from past experience, was that you never let the inflation genie go out of the bottle, because once you get inflation running through, it is extremely, extremely hard to fight. So Volcker, for example, uh, which we recently lost, probably the last decent central banker, had to raise rates to 20% to manage to fight inflation. And a lot of people don't know. I mean, I wasn't trading back then, obviously. I was born in 1980. But I like to read a lot of financial history, etc. Back then, when Volcker was, I mean, today Volcker is being celebrated as one of the most successful central bankers ever. Back then, when he was raising rates repeatedly and bringing them to 20%, Wall Street hated him. Politicians hated him. The good thing is that he had Reagan support. So Reagan supported him, also probably one of the last decent presidents. Reagan supported him, and he did what he had to do. And he solved the inflation problem, which, of course, its beginning was with the indirect default of the US in the 1970s, 1971, because in essence the Bretton Woods event was an unofficial default, right? Because once the world started worrying that the US cannot anymore repay its obligations via gold, because up until then, the dollar was backed by gold. So everybody was accumulating dollar as the world reserve currency, knowing full well that, okay, it's not dollars that I'm holding in essence, it's paper currency backed by tangible money, which is gold. So in 1971, Nixon had to admit that there is not enough gold in the US to actually repay the obligations. So then the dollar suffered vastly in the 1970s, and that, of course, brought inflation. That, along with some other factors, brought inflation in the US. And Volcker and Reagan had to actually fight that. I think we're going to see a repeat of the 70s. We're going to see during the 2020s, we're going to see a weak dollar. As I said, that doesn't mean it's going to start now, right? It doesn't mean it's going to start next month. I mean, we have the US US elections coming in November, and who knows? Until then, they might manage to to keep everything in check. But I do believe that following that, we're going to see a long period of dollar weakness, and dollar weakness, knowing full well that the US has a huge trade deficit and the vast majority of the products being bought in the US are not created in the US. That means lower currency, higher inflation, and we're going to start seeing those that know what that means, the misery index going higher once again. So I don't think this is going to be a beautiful decade for the world in general, and I'm pretty sure it's not going to be pleasant for the US as well. Or
Steve, having excuse me, having said that, a big part of the world celebrates when the dollar weakens, right? Because a lot of dollar-denominated debt. So.
Yeah. I mean, emerging markets should really overperform under a regime of dollar weakness. There is no question about it, because their debt burden is going to suddenly become, a lot better. I mean,
can you name a few emerging market countries for our viewers that they may not be aware of?
Well, you have South American countries,
the South American countries, first of all.
All of South America.
Almost all of South America, yes. Actually, almost all of South America. Then we have plenty of Asian, plenty of Asian countries
like
as well.
Vietnam would be a good example.
Almost everything. I mean, Malaysia, Vietnam, Turkey. Of course, Turkey has its own, esoteric issues as well, because one of the main reasons that Turkey is suffering is
Erdogan.
Yeah, political choices made by Erdogan, but there's no question about it. Turkey is also going to benefit from a weaker dollar. There's no question about it.
Oh yeah, I mean, it was one of the first currencies to really cave, the lira.
Oh yeah, and not only that. Since we just mentioned the lira, and then I'm going to go back to the more traditional ones. Not only that, Dale. Look at this. This is the USD Turkish lira, and as you see, it has been actually breaking out since the end of last year, since mid-December, while this was a period that the dollar was not doing well. So we're seeing the Turkish lira underperform the US dollar even when the US dollar is not doing well. So, Turkish lira remains one of the weakest currencies at the moment. I mean, we've had that, and there is a lot of speculation that they will not manage to avoid the IMF. So things don't look that rosy, having to do with. Although, if you look at the long-term horizon, Turkey has something going for it, which other countries don't have. Turkey, for those that don't know, has one of the best demographics on the planet. So it has a very young population, very, very young population. And given a shift and change of political direction, Turkey can actually perform quite well. But I don't think it's going to do so under Erdogan, because he has his eyes set on other stuff. Have you seen the monthly candle in the? Yeah, I have seen the monthly candle in the pound, and yes, it does look quite bearish. And if you want my personal opinion having to do with the pound, I do think that there is a decent probability. We saw this ascending channel being overthrown. We tested the 61.8, and I have to tell you that I see two scenarios going forward with the pound. One is consolidating. This is a 4-hour chart, by the way. One is consolidating its recent gains in some kind of form, like a triangle. So we might start like oscillating, between this low at 129 and that high at 135.15 for a period of time. So this is before we resume higher. So this is one likelihood, and the second likelihood is that we might see another leg lower than 129, okay, before we can actually see higher levels. So these are the two scenarios, in my opinion. But I would have to agree with Blake, meaning I think that eventually within the year, pound is going to be again a good buying opportunity. As I said, it is too early and we haven't seen enough price action to tell you if that's going to be later on at a level higher than 129.10 or later on at a level lower than 129.10. But in any case, I do think that no matter which path of correction the cable selects, I think that it's going to be worth buying it later on. That's what I think. Now, there were also questions about the Kiwi has some more downside of these highs. That was for Blake actually, but you know, I'm more than happy to answer that. Now, having to do with the Aussie and the Kiwi, I have to tell you that first of all, they've both produced some very nice bullish breakouts. Okay. For me, the big event for the Aussie was a daily close above 69.25, 69.30. We saw that happening. And for the Kiwi, it was that triggering, which happened some time ago, of that inverted head and shoulders formation. You can see it there, which, you know, completed. I mean, we overshot that actually. But as I was saying in the previous webinar, you know, especially the Kiwi is extremely, extremely overbought. So I was expecting some type of a pullback before we can see higher prices. And as you see, my general outlook is that as long as we remain above this broken trend line resistance, it's probably worth buying it again. But you know, it was extremely oversold. I mean, the daily RSI had reached almost 85. So, you know, buying it up there made really no sense. It will make sense to try to buy it if it retests this trend line, right? And having to do with the Aussie, it's going to be worth buying if it retests either 69.30 or even it can move a little bit lower because we had this descending channel. We might even come down and retest this broken channel before we move higher. But 69.30 initially should be a very strong support area because it was a very strong resistance area, and usually, you know, strong support becomes strong resistance, and vice versa. Strong resistance becomes strong support when retested. So I would have to say that, especially as long as we remain above 69.30, you know, you have no reason to look lower. And you know, the closer we get to these levels, the better the risk reward to attempt being long once again. Let me go through more of your questions. So, Happy New Year to everybody. Crude's been inching down. Aussie Kiwi in favor of Aussie Kiwi sell mode. You mean Aussie against the Kiwi? Yeah, listen, having to do with the Aussie against the Kiwi, this is what I'm saying here. I'm closely monitoring the, you know, this triangle. I think that if we break above it, which we're currently testing resistance once again, we might see a bigger bounce higher. But one thing is for sure: if we take out this trend line, we're headed quite higher. I mean, next stop is 1:26.45, that previous spike low. I do agree. The Aussie against the Kiwi looks very, very, very heavy. So I would be very skeptical about buying it. Probably it's in sell the rally mode if we see any rally. So I would have to agree with that. The market is very confusing and moves like waves, doesn't follow any rules. Yeah, it's not exactly like that, but yes, I mean, periods of the year that, you know, have very low liquidity, price action is quite hard to decipher, and it's very likely that you're going to get, you know, caught up in some kind of a false breakout or whatever. Oh, I forgot to comment on the previous friend's initial point having to do with crude inching lower. If you remember, I was very skeptical about that breakout we had during the holidays, and I still am. I like the fact that we got rejected having to do with crude from this confluence of this ascending channels resistance and the 88.6% fib. You know, does this make it bearish as we speak? No, not yet, right? But I am skeptical about the upside because I am skeptical about this rebound. I mean, the form of this rebound so far is, in my opinion, corrective. So I think that risk reward still favors people that want to be short. Now, it's not an easy trade, but that's what I think. NFP news moved for next week, guys. There was no volume. Never. Yeah, true. Could you guys have a look at USD Singaporean dollar? Yeah, actually, I am paying attention to it. It's one of the exotic pairs I am paying attention to, and it's at a very important support zone, as you can see here. So we have been moving lower from, after retesting that support resistance area there at 139 and change, we have been moving lower in a channel. And as you see, we are reacting higher. Actually, we have formed today a bullish engulfing candlestick, which is quite a rare candlestick to find in FX. We have formed a bullish engulfing right on this support previous lows as well. So from a risk reward perspective, a rebound from current levels looks appealing, right? And the first area of resistance, I would say, is roughly at 135. So, it is a decent area to buy it. And if it ends up producing a move that breaks through this descending channel, I think we're going to see more strength towards 137. That's what I think about the USD against the Singaporean dollar. So, quite a good question having to do with timing. Silver, gold, copper pulling back. Yes, copper is pulling back. I did mention last week that copper was testing key resistance, support resistance area as resistance. Where is it? There it is. So, and I actually drew that back then, that, copper might pull back from that area. You see that was the confluence of this ascending channel and this horizontal support resistance area, both passing from 285. And I said that even if it wants to remain in bullish mode, it should still pull back perhaps towards 272, another support resistance area, before moving higher. So risk reward ratio, I said, favored short positions, as I said now about crude. And yes, it did get rejected from there. And yes, I do believe that it can easily end up pulling back towards 272. That's what I think about copper. Now, in order for me to turn bearish copper, I would need to see this ascending channel breaking to the downside. Okay, that's when I'm going to be looking for a lot more weakness for a move towards 240 or whatever. Now, having to do with gold and silver, they both remain in breakout territory. There's no question about it. I have no different way in saying it. I have been, and I remain very bullish, having to do with both the metals, both from a technical and fundamental perspective. So, in my opinion, buying the breakout, as I had mentioned, from 1725 in silver and 1485, 1490 in gold was the right move. And any type of pullback, as long as we remain above these levels, is a buying opportunity. As simple as that. And as I mentioned at the very beginning, look at palladium. Palladium is actually breaking higher from a multi-year descending trend line resistance. So this whole period here looks like a period of consolidation / accumulation. Next resistance I see is at 1029, and above that I think we're going a lot higher. And this might be the decade that platinum signs once again. So, I would not be trying to fade this. I can tell you that much. I mean, it's already 2.7% on the day. It's already 2.5% lower against, higher against platinum. Against palladium. And as I said, I like this trade. I like this trade very, very much. Hi guys, happy new year. Could you please evaluate AussieCAD? Yeah, I can gladly have a look at both AussieCAD and KiwiCAD for you. AussieCAD, let me start from KiwiCAD because it's much easier to talk about. So KiwiCAD had broken above this descending channel. It is pulling back. This is the second consecutive trading day. It is pulling back from very overbought territory, as you see. But, you know, 0.86 is support. So it might continue higher. Now, having to do with AussieCAD, it's a little bit more complicated because I was looking at this inverted head and shoulders formation as a nice buying opportunity. I didn't buy it due to vacation days and due to the fact that it's not a fast mover, so I wasn't really afraid that it's going to really run away. And it so far it seems to be showing us that perhaps that was a false break higher. Now, does this make me immediately bearish? Not actually. I'm going to have to say that the mode I'm in is like give it a little bit more time and monitor it a little bit longer and see because we have holiday flows. If it actually wants to legitimately break above like 91.10, or if that was just a false move to the upside. So I remain sidelined here. I liked it as an inverted head and shoulders formation, but I obviously don't like the fact that it has turned lower. I want to wait more above 89.70 here. The lows of the right shoulder. I can really, turn bearish. But as I said, I don't like the fact that it has already moved back through this neckline. So, wait and see mode here.
Okay, buddy. Interview time?
You might be right, Ziggy, about that. No, you are definitely right that Carter hired Volker. I have to see. Perhaps you're right. I'm going to check it later on. Perhaps you're right on that, Ziggy. I'm going to check it after the webinar, actually. Happy 2020, Dream Team. Should Bitcoin not get fueled? Well, yeah, interview time. Give me 1 second just to cover the last few questions. Repo crisis could lead to midterm USD strength. That is true, Baroque. There's no question about it. As I said, our viewpoint having to do with the dollar is not like a short-term viewpoint, right? Not what's going to happen during the next month. Bitcoin not get fueled with a getting weaker dollar. Depends. Nobody knows what's going to happen with Bitcoin simply because, for example, Bitcoin hasn't been tested through a full business cycle. So we have no idea how Bitcoin is going to react, for example, to a recession, right? We've never seen what Bitcoin or cryptocurrencies will do during a recession. But I have no idea. I mean, if you have a monetary system strain, do you actually run on untested cryptocurrencies or on 5,000-year-old tested real money, which is gold? In my opinion, you know the answer. Having to do with what I believe, you know the answer. I mean, you go to the precious metals. But does this mean that Bitcoin can't also overperform, especially if we have a weakening dollar? It can, but something, cryptocurrency lovers want to have it both ways. So whenever Bitcoin is not overperforming other assets, they claim victory because Bitcoin is an uncorrelated asset. Whenever it is overperforming other assets, they claim victory because Bitcoin is overperforming other assets. You can have it both ways. I mean, it's either an uncorrelated asset, which in that case, who knows what it's going to do, right? During a period of crisis, or you believe it's going to be a safe haven, in which case, yes, it should catch a very decent bid, right? I find it strange that you call neoliberal Reagan as a decent president. He was an actor, and the real president was George Bush with support from the CIA crowd. I'm not going to go into this conversation. But suffice it to say that my opinion remains that during that era, Thatcher in the UK and Reagan in the US were the last decent politicians we had in the UK and US respectively. That's my personal opinion. Okay. So, coach, interview time. First interview of the year.
Okay, Steve. Hiya, Dana. Steve, I have a question. Are you there?
Yeah, absolutely.
Okay. Just hypothetical.
Mm-hmm.
If someone comes to your house that's a
Mhm.
guest,
Mm-hmm.
okay, and they knock on the door and they're there, do you have to answer all the people in the house their questions before you let the guest in your house?
We're not that late, coach. It's 3
Okay.
minutes past.
I'm just saying. Just
No,
something to
but
think
you know,
about.
we were almost done with the question. So
Okay. Anyway, when someone knocks at my door and they're a guest, I let them in right away. Okay, so Dana, it's going to be great to talk to you. It's been far too long. So I'm going to make you a panelist. I don't know if they have the golden rule in Greece. Hold on, let's see. Dana.
the golden what?
Golden rule.
Which golden rule?
Do unto others as you would have others do unto you. That's a golden rule. Okay, so Dana, you have to
Yes,
activate your mic. Are you there, buddy?
Yeah, I'm here.
All right. I just
all right,
had.
Can you hear me?
Can hear you loud and clear, all the way from Chicago.
Yeah, believe it or not.
Sorry about the Bears.
Well, that's
Well, and
I'm a
Bears in the
Cubs
market,
fan.
Bears on the
Well, I'm
football
a
field.
Cubs fan, so
Me
I've
too.
learned my glass has been half empty for a long time in Chicago. So.
Yeah, I thought it was
Yeah.
surreal when they won the World Series. I thought it was an episode by Rod Serling. So,
Right.
Dana, I really
right.
want to see your setup and some of the things you may be looking at. So you see there's a green share box.
Yeah, gotcha.
And you could share your screen that way.
Okay.
You just click the share.
It says you cannot start screen share
now
while
you
the
can.
other participant. Okay.
You can now.
Okay.
Zoom.
Is it working?
Long Zoom for the Zoom ride?
Zoom.
That's what we're using. Yeah.
I like it though.
Okay.
Share.
Yeah.
See. Share. Is that working?
Yeah. It's coming up. Yeah, we got you, Dana.
Okay.
So Dana, it's been far too long. I can't even remember how many years ago
it's been a couple of years.
Yeah, had a conversation. So, bring me up to date what you've been doing, because I know that you had an association with those guys at See It Market, and then I went and looked at your site, and you're also contributing content to Yahoo Finance.
Yeah, that that partnership kind of has fallen by the wayside. Well, they more or less scrapped that the Yahoo Finance program that they started. It was called Contributors on Yahoo Finance.
Okay.
So as far as I believe, I do still have a Tumblr blog, which all the posts on Tumblr did feed through Yahoo Finance, and as far as I know, that is still the case. And I do contribute to See It Market from time to time, but we've kind of shifted our, the social media campaign a little bit. About 2 years ago, a lot followers and some of my readers, a lot of readers wanted a little bit extra in terms of, we have all this original research we put out and charts that we put out. People are always interested in the charts, and they wanted some next level stuff. So we're at the point where, okay, we're sharing all this stuff online, not seeing the benefits necessarily from it. So either we're going to scrap it or we're going to actually go to the next level and give people, the inside scoop. So research and charts that we were sharing, people wanted to know, okay, what's
Okay,
the
your bread
traction?
and butter, your bread and butter is the registered investment advisor, and you also have I see something where you have a program for IRAs.
Yeah. So we have the bread and butter is the RIA, the Registered Investment Advisory, where we
You have a
manage
good year
funds.
last year.
We had a good year. Yeah, we're on a nice roll, so that's good. What I was going to allude to, we did start 2 years ago. We started what added on to our social media campaign. We started more or less a premium trading site. So we
Oh,
do share all of the charts and research that we're sharing, but we took it to the next level. So now we're for this premium, it's called Lions Share. You can go see
okay.
it at lionsharepro.com. So what we do is same thing we were doing, sharing original research and charts, but we took it to the next level. So now on a daily basis, we have pre-market videos where we
You
show
talk entries. You
yeah,
talk entries, and yeah.
all the research, the behind the scenes research, all the charts we're looking at, actual things we're looking to buy and sell, and the specific levels and that type.
Well, I don't know. I was disappointed when the Wizard of Oz came from without outside the curtain.
Yeah,
He
well,
was
at
much
least,
more mysterious while he was behind the curtain. But
yeah,
I
there
wish
is
you,
something to that. But
yeah. So
at least there's transparency to the Wizard.
yeah, and there's a lot of good work out there, Dana, and I remember you being an excellent technician. So why don't we get to it?
Sure.
What's that? The value line?
This is the value line geometric composite. Yep.
Okay.
So
So the message to me looks like an ascending triangle, like we're on the verge of a major breakout.
we could
Maybe
see
after a pullback here, or what?
we could see very well see higher prices. Our bread and butter is a quantitative risk model that we started back in the 1970s during that whole secular bear market, and uh, where we learned quickly that okay, stocks, the markets don't just go up; they go up and down. So we want to be on the right side of the market, and we use a lot of breadth and internal inputs to figure out where the bulk of the market is heading, and that's the right side. That's the side of the market we want to be on. And right now, our risk model is still constructive. Pretty much all the breadth and internal measures that we follow are still pointed upward, still constructive. So where one of the main drivers for much of this rally has been the large caps. So we've had here's the S&P 500,
Right.
obviously been
Yeah.
moving higher for a long time, broke out to new highs several months ago.
Do you get any message from the VIX that we've made one heck of a run? I mean, all the way back to last year, the worst December ever. And
Yeah.
VIX, for some reason, seems like there might be a new regime. It's not trading in the tens anymore.
The VIX, we were seeing a major divergence back in before I would say before this real breath breakout, and call it October. So we kept seeing higher lows here in the VIX. Around here, October, November, when we saw that breath thrust, we saw an acceleration of basically the broader market. The small caps broke out, mid caps broke out. VIX, we saw finally a lower low. So I think that's constructive for the market, for stocks in general in the near term. We're also seeing, along with that, the Russell, the small cap breakout. Another encouraging thing that we're looking at is the mid caps, which is the mid cap average now testing those highs from those all-time highs from last year, October, August, September, consolidating there, waiting for looks like it's building energy for another breakout higher. So we're still seeing a lot of constructive things as far as the internals and the breadth, and as long as those continue higher, we're going to be constructive on the market, whether it's it was by and large the large caps for a long time. Now we're seeing broader participation. We're also seeing broader participation in terms of international markets breaking out, various rotation among the sectors. You know, for
You have a
much of
view
the
on the
year.
dollar, looking at emerging markets and so forth, that perhaps we have put in a significant dollar high, and does that go into your equation when you look at markets that suffered under a strong dollar?
It doesn't really. Our
Okay.
niche is the equity market and this risk model that I was mentioning. A lot of it pertaining to internals and breadth. So that's our
Okay.
that's really our core.
No
edge there.
divergences in
But
any of the breadth numbers and
no,
internals that you look at? None?
no major divergences there
Huh.
as
Okay.
far as we're concerned on the in terms of an intermediate term, which is our that's basically the duration that we focus on. So that's anywhere from 2 to 6 months. As far
Okay.
as the dollar, I would say near term, the I don't know that there's enough evidence to tell us that the intermediate term uptrend is over. Certainly in the near term, I think path of least resistance is certainly lower here. Broke this nice uptrend line from
Yeah.
the 18 early 18 low, and path of least
Well, I
resistance.
think that
is down
I
on the
actually think
dollar
that may
index.
be the catalyst for some of these overseas markets
It
starting
it
to do better, right?
it very well could be. I mean, that's that's the general
We-
thinking. I think
Trading 101.
yeah, exactly. But I mean, if you look at some of these other, if you look at some of the emerging markets that we've been looking at, this is why we rely on prices, not necessarily this intermarket analysis where okay,
Oh,
the
yeah.
dollar's heading up,
Correlations. Yeah. They
yeah,
break
because
down.
correlations change. So we've
Yeah.
been looking at all year last year and even longer. We've been looking at Brazil and Russia. Here's the MY6 composite in Russia. So the dollar was trending upward, right, all last year. Look at Russia has been moving to new all-time highs for the last couple of years since breaking out above these 07, 08 highs. Here's Russia continues to move to new highs. You look at Brazil. We've had the rising dollar for the last several years, or at least about the last
Yeah,
several
that
years.
definitely
But
disproves.
Brazil's been just cranking higher ever since the real breakout in 2017 above those 08, 09 highs, came back, tested in 2018, but it's been flying higher. So you've had depends on what emerging markets you're looking at. You know, a lot of it is heavily weighted towards China, which has been terrible, and we're not fans of China. As
So
far
let
as
me ask
stocks
you
are
this.
concerned, and you look at the broad emerging markets index, which is heavily weighted to China, and it's been severely underperforming. So as far as that is concerned, yeah, that's been struggling. Maybe the dollar is aiding this one now, but you have various emerging markets around the country, around the world, that have been rallying already despite the rising dollar.
So what do you do with all the advances we have coming into a new year with fresh money?
Again, price is true. So we keep following whatever trends are working. It's as far as the broad stock market. Again, our risk model, our indicators are still constructive. So we're still in buy the dip mode. We are not in chase the market's higher mode. You know, we're not fans of chasing markets. So,
You would wait for a pause?
Yeah, we're patient in waiting for pullbacks, and we like relative strength. So whatever markets are working now, we like to focus on those. But you're seeing even among the equity markets, you're getting chances if you're patient at various entry points in longer term relative strength. For an example, we bought. We've been buying technology and healthcare and whatnot in the pullbacks, but even a couple weeks ago, you saw an acceleration of the upside in some of the large caps, some of the broad markets. But you had opportunities, for example, in real estate and the REITs, which had a great year. We've been on those all year, but you look back a couple weeks ago, here's the iShares real estate ETF IYR pulled back, and this was while we were breaking out in the broad markets, pulled back to support here on the
Kind of
IYR.
looks a lot like TLT.
Yeah, it looks a little bit like TLT, but we're accelerating now to the upside in again in
Housing.
the REITs and real estate. Got a
Yeah.
nice bounce here in RWR, the REIT index, and this is in the face of rising yields as well, which in this yields were kind of putting a
Yeah.
headwind on this real estate here recently, but getting a nice bounce off of there. So again, the intermarket analysis stuff, sometimes it holds up, sometimes it doesn't. So we'll just we like to trade as far as we go along with our model. As long as it's bullish, then we're going to be buying stocks. As far as what we're buying, we like to rely on each individual chart on its own merits, not is the dollar moving up or
You
down.
have a view on yields?
Yields, sure. Depends on your
Yeah.
depends on your
They're not-
time frame. Okay.
Yeah,
we've got-
like we're starting to get a decent steepening, aren't we?
Yeah. So from a long, 30,000 foot perspective, we think yields are long overdue for a long-term bottom. So we've been going down for decades. I think
30 years.
we're in a bottoming process, where we're going to head up in yields for several decades to come.
Okay.
In the near term, if you zoom in, you skip the intermediate term, near term, I think we do have further upside to go on the 10-year. If we get above this 196 level, we're probably testing 212, maybe up into the 230s. But I
Okay.
think that's going to be a buying opportunity. I think we come down, maybe test these former lows again, or at least get
Yeah.
a decent buying opportunity in bonds before it's off to the races for the upside.
Interesting.
So
Kind of meshes with what I've been thinking about in
Okay.
here. Okay. So how about, the miners have really had a nice run in the last few months or
yeah.
quarters. Anything in the miners, and the oils have been disappointing for a long time, and crude's trying. You see
Yeah.
anything in the oil sector?
Oil sector, we're not that high on commodities in general, and
Okay.
crude oil in particular. Here's a look at the commodity index that we favor, the equal weight commodity index.
Okay.
Recently broke down below this multi-decade uptrend line. So on the plus side, it did break this downtrend line from 2011, which opens up in the near term further upside. So I think there's a little wind at the back in commodities right here. We would be sellers into any major resistance. So I think any rally here is probably a selling opportunity. Same thing.
And this is a commodity index.
This is a commodity. This is an equal weight commodity index. So you look at
Okay.
the CRB, it's really heavily weighted towards crude oil. This
Right.
one spreads out the weighting among
Ags and everything. huh?
Yes, exactly. If you look at crude oil, this is a GSCI crude oil index that we look at. It's basically the same thing. I mean, we're seeing still way lower highs across the board. So nothing in our view to get excited about yet
Okay.
as far as crude. So we'd be sellers. But you mentioned precious metals. This goes to show you what a great year 2018 was for investors. I mean, it was we were basically in buy the dip mode in stocks, bonds, precious metals.
Yeah, everything.
Most of the year. Yeah. So
Why do you think that is?
I mean, people are going
Could
to
it
point
be
to central
Fed?
bankers. Yeah.
Yeah,
Fed,
but you don't
easy
believe that.
money. I mean, I think that is certainly a component to it. When we're managing client money, we can't rely on that to make our investment decisions. We got to go based on the charts and what the market data is telling us. So I think there is definitely a component of that to it. But bottom line is we don't care why it's happening. We're just going to go with the trend. So As far as gold miners and precious metals, we're in buy the dip mode still. So GDX, we trade the ETF. So GDX breaking above, it formed a nice little pullback here. We're in buy the dip mode back above that 61 retracement now from that little dip here. So
Okay.
looking for higher prices there. One interesting thing, if you look at the skip the ETFs, you look at some of the broader indices among the precious metals. You look at the gold bugs index, which I don't think anyone looks at anymore except
Yeah,
us.
they
But
don't.
yeah, I
It's
mean, you're
making
seeing
new
higher
highs.
highs now.
Yeah,
So
yeah.
above those August highs. Same thing with the XAU. A lot of people look at. So that's a great sign. Same thing with the metals themselves. We trade ETFs. We
GLD.
don't trade. Yeah,
Yeah.
GLD, SLV. GLD also testing that 61 retracement now, so could get some consolidation here, but no reason to think we don't continue higher from here. Same thing with SLV. Bought SLV on this pullback to around this good support around 1560 on this nice bounce. So we do have upside immediate term to that 61 retracement around 1720. Might get some consolidation, but we think this one goes higher as well. So we're
Okay.
still in buy the dip mode and precious metals as
In
well as
everything.
stocks. Yeah,
Okay.
pretty
Huh?
much in everything. Yeah. So
All
take it
right.
take it while you can get it, right?
You know, you're right. Make hay while the sun shines. How about
Exactly.
you have any view? I know it has nothing to do with trading, about all this, talk and all this, people trying to figure out what's happening in the repo overnight market. You're from Chicago. What are people saying about it?
Yeah, honestly, I don't have
You
an
don't know?
opinion on that because anything that doesn't really feed into our models, our
Boy,
quantitative
are you a
models, I don't.
disciplined guy. I can't even
I
get you
try
to
to.
I
I've
can't even
learned.
get you to BS with me. You don't have to trade it, but
Hey, I've learned through a lot of mistakes in
yeah,
whether it was Y2K or
yeah.
going way back or some of this
Do you still
some
make mistakes?
oh sure, obviously make tons of mistakes all the time.
Okay.
But the more and more mistakes we make, the more and more we learn. Okay, follow the rules, follow the quantitative models. They're a lot smarter than us. Follow the objective data. The charts are going to be a lot more truthful to you than certainly the news headlines. The great thing about
Yeah.
news headlines,
Yeah.
people get whiplash back and forth on them, and
Yeah.
you have these Fed meetings periodically where you
Or
get
trade.
volatility.
Yeah.
Yeah, this a tweet comes out.
Yeah.
These
Yeah.
things are great. I mean, in the
You
near
like 'em.
term,
Yeah. All right.
they're opportunity makers. In the near term, it's going to. Bottom line is it's going to be noise. All this stuff is noise. Follow your process. If you have a quantitative and objective process, follow your process. If the market reacts contrary to your positioning, it's going to be noise. So fade it. If it presents if you're long, you're looking to buy it, and Trump comes out with a bearish tweet as far as the trade dealings and the market drops. I mean, that's a buying opportunity for you. Use it
Okay.
to your advantage. If it pops higher, there's no reason you have to chase it higher, So it's like either way you win, if it moves the needle in your direction, then take it. If it moves the needle the other way, use it as a buying opportunity. Yeah.
Add on.
So people tend to get emotional, which is what disciplined technicians are always gonna give them the edge because human nature is gonna drive these markets. So use that human nature, the emotional reactions to your advantage. And
Worst drawdown in the last few years during the prolific bull market.
Our worst drawdown has probably been during times where our risk model is rolled over into some indication of a higher risk market and a higher, elevated risk, and we've taken chips off the table where the market's just continued to head higher. So
okay, so it was opportunity costs, not
opportunity
drawdown.
costs for sure. We've over the years, over the decades, we've kept
Yeah.
our actual drawdowns very low to a minimum, but opportunity costs for sure, especially over the last 10 years, where we have thought, okay, the secular bear market started in 2000. It's probably going to be drawn out for the better part of 2 decades. Whereas,
Yeah.
in reality, the last 10 years have been more or less not straight up. We've had decent intermediate term corrections in 11 and 2015 and 2018, which we
Okay.
avoided a lot of the pain.
Yeah.
But perhaps certainly at times we've not been aggressive enough in
Okay. That's interesting.
Yeah.
I know it's just an opinion, but it's a pretty long expansion, pretty long-term bull market, and I know you're just going to go with your stuff because it's smarter than us, but you've been around for a long time and you're a veteran. And just gut, you think we have like another great year going into the election?
I don't know what the bulk of the year is going to do. I will tell you right now that our stuff again is still positively positioned. We're seeing a lot of breakouts, which have not always worked over the last decade or so. You get a lot of
false breakouts.
False breakouts. You come down, correct, and then you move higher. But right now we're seeing a lot of positive factors out there that has us right now pretty long and looking to buy the dips further.
Okay.
So until that breaks down, we can't be that negative on the market. I will say longer term, we're still of the mind that this here's a perhaps a contrary opinion for you. Long term,
Okay.
we think we still might be in a longer term secular bear market that started in 2000. This
should be interesting.
This whole breakout, yeah, from 2013 when we broke the highs. We're still not sure that this is a sustainable bull market, a sustainable breakout. Would not be surprised to see once this whole song and dance ends that we go down and test at least those 2013 breakout, and perhaps even further. If you look at, here's the Dow. The interesting thing to us is that right now, even a retracement, 61 to the 61 percent retracement from the current highs. Look where it takes us on the Dow.
16,000.
Right down to this breakout point above those.
But how could you call it after what it's done since 2000 still being a secular?
That's why it's a contrarian. That's why it's a contrarian opinion. But if you take it back further, let me pull up a longer term chart. So the way that 2 points. This will feed into your whole the whole central bank Fed argument. Okay, in 2013, sure, we broke above those the former highs. 1500 and the S&P broke to new highs. Went to we have this breakout. Our feeling was that that the secular bear market did start. There's an email from you. Our secular bear market did start in 2000, and that a lot of the excesses, if you go back hundreds of years, you always have secular bulls, secular bears. We have always gone to, once we go to an extreme to the upside, we've always gone to extreme to the downside, not just in prices, but in various metrics like valuation, in price versus
book value,
trend, value, in the percentage of household assets and stocks. That never happened in 2009. Maybe we went back to about the mean. We've always gone to the other side of the mean before a secular bear market has bottomed, before a secular low has been put in place. So I think that's where the central bank and Fed intervention has prevented a lot of that correction from occurring naturally, which at this point, the problem is we never corrected those first excesses, Now we have additional excesses on the books that need to be corrected before a sustainable bottom is in place.
Because we would have well been coming out of it without the intervention.
Yeah, I think
probably
we'd
by
be
now,
right on pace
right?
right now, right?
Yeah.
So
Okay.
because we had a
So we have to
an
pay the
18
piper even more when
exactly
when the musical chairs game ends.
exactly we had this 18.
Will you call me the day? Huh, buddy?
Sure. Well,
hit me up on
they
Twitter.
say bottoms are easier to point to than tops, so
Yeah.
maybe the bells will be ringing.
Well, they say that markets top with violence and bottom in silence.
You know, if you look at the volatility indices, you look at the VIX, I
Or
think
you don't
it's
have
the opposite.
violence yet.
I think it's the opposite. You know, you have
Really? Oh yeah, with
you kind of-
complacency.
yeah, you look at this top as kind of a process, whereas the bottom, you bottom like violently. The VIX spikes up to 1 million or
I'm not using that saying anymore.
yeah. Well,
thanks,
I don't know.
buddy.
You can use it. That's our if you measure by volatility, I'm just saying it's kind of like my father always likened to it to like you throw a ball. You know, you throw a ball in the air. The pace of acceleration slows to it almost stops in midair and then falls down. And when you drop it on the ground, it bounces up immediately, like quickly. So that's what I liken it to. Going back one more thing to our price, you said, how can we be in a secular bear market if we're moving to new highs? We always measure the secular bears from low to low. Okay, so you go back to this 1966 bear market. We bottomed in 1982, right? Everyone picked it off in 82. Well, we had already broken to new highs then, and we're certainly above those 1974 lows. But what we did was basically in 82 came back and tested a lot of the highs from the 66 to 82 bear market, came down, tested that, and then we kicked off the bull market. If the same thing holds now, then possibly we come down after this great bull market's over. Maybe we come down, at least test, which would be about a 38 retracement down to the 2015-16 highs.
Yeah,
possibly down if it gets bad, which I wouldn't put it past the market
back to the breakout.
Back test those 2007 highs, which would be about a 61 retracement. So
what a great interview, man.
Yeah. Well,
what a great way to kick off 2020. Why don't you show your website so people know how to find you?
Perfect.
And your Twitter handle is JLions Management at JLions Management.
Yep.
And our JLions Fund Management.
JLions Fund MGMT. Yep. Would be our Twitter handle. We do still have a Tumblr. You can search for jlfmi.tumblr.com for a free Tumblr. We also have, this is our new kind of our all access website is lionsharepro.com, where we'll give
you're not showing it, you're showing the chart. You have to probably have to stop the screen share and then show it again if it's on a different screen.
Okay, let me try to figure that out. Okay, stop share. How about now?
Share again.
Perfect.
Okay, there you go.
All right. Here's our new all access site. Again, we give every day before the pre-market, I'll give a outlook, short and long term, as well as we'll give a video, update all the charts that we're looking at, what we're looking to buy and sell, and also real time posts if we're on any sort of a major high conviction trade that we're looking at. So right now, again, that's mostly by the dips in stocks and precious metals and even bonds. So again, on Twitter, you can get a hold of us on Twitter. There's our Twitter handle. There's JLions Fund MGMT and
the skyline on Lake Michigan. I'll tell you what, Dana, it was great talking to you again. I wish you a lot of success in 2020, yourself, all your clients, money that you manage, that it multiplies for you. But my trading warrior brother.
I appreciate Dale. It's been way too long. Let's not have it as long next time, right?
We won't. So
Happy New Year, buddy.
Happy New Year, Dana. Everyone, that's Dana Lyons. Happy New Year, everyone. Let's kick some butt this year. Let's support each other. And most of all, don't just count your pips, count your blessings. And we'll see
Absolutely.
everyone to wrap up the week tomorrow. Adios, Dana.
All right. Take care, Dale. Thanks a lot.
All right. Thank you, bro.